Speakers of the evening, my dear friend CA Sudhir Soni and CA Suresh Yadav, Vice President CA Sunil Gabawala, Member of the Accounting and Auditing Committee CA Yogesh Patel, and my dear friends present here and those watching live on stream. A good evening to all of you. Before we come to the subject of the evening, a few words about BCA's annual plan this year. The four pillars on which BCA will focus are transformation, Yuva Shakti, digitization, and networking. Most of the programs this year will try to focus on these areas. Membership growth, being part of both transformation and Yuva Shakti, is one such area. We are about 9,200 members in BCA at present, and we wish to cross the 5-digit mark this year. Please spread word about BCS and make as many members as possible, is my earnest appeal to all of you, especially the youth, which is our future. Friends, one continues to hear about the pace of change more frequently nowadays in professional as well as social circles. We are living in an age where what is true today may not hold well tomorrow. The pace of change in technology is second only to the speed of thought nowadays, and coupled with ease of access to information, this has made economic sphere more open and transparent for one who wishes to plunge and take risks. This also brings about high redundancy levels for humans as well as organizations. One must continuously keep on changing the manner of one's processes of thinking, working, planning, positioning, serving to survive in the maddening pace of life and work which many of us are unaccustomed. One cannot achieve anything by resisting the change or its harbingers for change. Is the only constant, and adaptability has been the hallmark of human species in its race for survival. At BCS, it has been our constant endeavor to keep the members attuned to the changes taking place by holding timely lecture meetings, seminars, workshops, refresher courses, etc., and also by way of publications in sharpening their professional skills to meet the challenges of change successfully. Coming to the topic of today's meeting, adoption of IndAS has been one of the most widely discussed topics across boardrooms in India for a while, and corporates have invested significant efforts and resources to ensure compliance with IndAS. Reporting of annual financial results under IndAS within the regulatory timeline has proved to be a testament to India's readiness and ability to successfully embrace such a significant change in financial reporting. In today's era of globalized economics, IndAS is a business imperative for Indian companies. Besides acting as a gateway to global capital markets, it should also strengthen the economic cooperation among BRIC nations and other regional forums. Its adoption is expected to result in accounting which more closely reflects the underlying business rationale and true economics of transactions. It is reported that around 600 companies were covered in the first phase of the roadmap. Sudhir will correct me if I am wrong. In the second phase, there are approximately 10,000 companies that will be required to prepare financial statement based on IndAS. As is evident from the IndAS results reported by various companies, the impact of adoption has been pervasive and not restricted to only one sector or industry. Net incomes of sectors such as industrial manufacturing, automotive, metals, and capital projects and infrastructure were impacted the most. On the other hand, revenue, taxes, and financial instruments, including derivatives, were the top three arenas of adjustment arising from IndAS adoption. Investors, stakeholders, and other users will see additional disclosures of financial information in the annual reports of companies, which will help better understand the company's business story, performance, and financial position. Finally, the impact of IndAS adoption has been beyond accounting, cutting across organizations and various functions areas such as direct and indirect taxes, contractual arrangements with customers, suppliers, lenders, HR and incentive policies, IT systems and controls, and requiring timely communication with varied stakeholders. IndAS implementation is also going to benefit the accountancy profession as a whole, offering it new professional avenues to serve global stakeholders and adding a new dimension to the government's Skill India initiative. Transition to IndAS involves huge efforts. Hence, any transition of this size and nature comes with its own sense of challenges. This Phased IndAS transaction process has been helpful, especially phase 2 companies, including banks, NBFCs, and insurance companies, as they can benefit from the transition experience and journey of phase 1 companies. To educate us and share their experiences, we have with us CA Sudhir Soni and CA Suresh Yadav. Let me introduce the speakers to you. Sudhir Soni is the National Director and Partner of SRB Co and LLP, SRBC and LLP, and Co LLP. Sorry, he is a Bachelor of Commerce from the Bombay University of 87 and a fellow chartered accountant of 1988. He happens to be from my college, NM College. Sudhir is a fellow member of the institute with over 27 years of experience and has worked on a range of assignments with expertise in financial due diligence, statutory audits of companies in manufacturing, retail, and consumer products, among others. Prior to SRB, he has worked with AF Ferguson's and Arthur Anderson and Associates. He has written a lot of papers and articles which have been published at in various magazines. He has been a speaker at various workshops on accounting standards, a special invitee to the Accounting Standards Board of the Institute of Chartered Accountants of India, member of CII National Committee on Financial Reporting, member of Shield Panel of ICI for its excellence in financial reporting from 10 to date, and impelled as a technical reviewer on the panel maintained by FRRB. He is also the co-chair of Corporate Governance Committee of IMC. With these words, I request our Vice President Sunil Gabawala to present a memento to Sudhir on behalf of the society. Coming to the second speaker, CA Suresh Yadav is a director of SRBC and Co LLP. He is a Bachelor of Commerce from the University of Bombay of 2002 and a chartered accountant qualified in 2004. He is a member of the institute with over 13 years of experience. Suresh has worked on a range of assignments with expertise in statutory audits, financial accounting, advisory matters of companies in manufacturing, construction, engineering, oil and gas, metal and mining. He has also led several IFRS, IndAS assignments and Indian IPO and AIM listing and other capital markets transactions. Prior to SRB, he has worked with AFF and Company, AF Ferguson and Company. Suresh has contributed at various forums, including the ICI, and he has led the preparation and participation in various study group meetings, especially on ICI guidance note on IndAS compliance Schedule 3, ICI application guide on implementation of Schedule 2, and the examination of the modification in existing accounting standards pursuant to Companies Act 13. He assisted ICI as a technical resource for expert advisory opinions, a speaker at WIRC workshop of awareness programs on financial reporting organized by FRRB. He is also a speaker on Companies Act workshop at CII in Nashik. With these words, I request once again Sunil to present a memento to Suresh on behalf of the BCAS. It is not that BCAS does only work related to the profession. Our foundation carries out huge social work. Recently, we made a 2-day visit to Dharampur in Gujarat, where we planted thousands of trees and helped in number of cataract operations. We are instrumental in building an eye hospital also there. We'll just show a small video and then I leave it to Sunil and Suresh.
भी अंबर से सूर्य बिछड़ता है, क्या कभी बिन बाती दीपक जलता है, क्या कभी अंबर से सूर्य बिछड़ता है, क्या कभी बिन बाती दीपक जलता है, कैसी है ये अनहोनी हर आँख हुई नम, छोड़ गया जो तू कैसे जिएंगे हम, तारा जय जयकारा जय जयकारा स्वामी देना साथ हमारा जय जयकारा जय जयकारा स्वामी देना साथ हमारा
Narayan, Sunil, Yogesh, committee members of the BCA, ladies and gentlemen, those here and those who are watching on the YouTube. It is indeed a pleasure for us to be at the BCA. I've done number of such interactions. I always like to call them interactions at the BCA because I go back with a lot of learning, and I also see in the audience a lot of distinguished people with very good knowledge of IndAS. So I always found this to be a very engaging and learning experience. Suresh and I are delighted to be here and share with you our learnings of what happened in the phase one companies. The way we have structured this discussion is on three planks. One is an overview of how we've seen the rollout and some tips around good project management, because I think it's a change management exercise. It's not merely an accounting exercise. That's something we should recognize. The second is that I think preparation of what's called the opening balance sheet under IndAS is by itself a very important activity, and it involves making some significant judgments, and also has both a lot of opportunities within that. So we have some discussion around the opening balance sheet, and then the third is around the ongoing topics which impact you as you go forward into IndAS, and also the presentation and disclosure. So I think those are the three planks on which we would be discussing. I would say that the move to IndAS is one of the most significant changes that India made. I remember if you go back about 5 to 6 years, and even during the Congress rule, there were four big changes that corporate India was excited about. The rollout of GST, at that time the companies bill, then the direct tax code, and IndAS. These were the four major initiatives that had been planned by the government. And any meeting we went to, people were excited about that. It's quite a coincidence that all of these have come to fruition very close to each other, except of course the direct tax code, much of which got incorporated into finance bills over a period of time. But all the other three, as you know now, have been implemented. So we join many countries which have converged with IFRS. So the big difference of, as you are aware, between adoption and convergence is that we have not accepted IndAS as it is, but we have certain carve outs. And amongst the few countries which decided not to, or continue with their local gap, 9 countries, as you see on that chart, you will be pleased or surprised to know that the US is one of those, which said, no, US does not mind convergence as long as you converge with US gap, so that's their idea of convergence. So But what's been happening in the last few years is that the US, the FASB and the IASB have been coming out with projects together. So some of the major standards on business combinations, financial instruments, leases, and revenue recognition have actually been joint projects of the FASB and the IASB. And so the differences between the two are minimal that have happened. There are some differences, but those are minimal. Coming to the India convergence story, there are carve outs and there are detractors who will say that, oh, India, you are saying we have adopted IFRS, but there are carve outs. I think if you carefully go through the carve outs, I think they are well reasoned carve outs. There is a good logic to them, and they have helped us to make a smooth transition. I feel the change is so significant that we ought not to be apologetic about the carve outs, that have been made in IndAS from IFRS. I think considering our national scenario, the situation, I'll just a very simple example is on lease rentals. Internationally, they say you should straight line, but internationally, there's hardly any inflation. In India, lease rentals often go up 5% every year. So straight lining may not make sense because otherwise the time value of money is not properly reflected. So I think the carve outs have a good justification. If I just have two, what I would say, criticisms of the rollout or the implication is, I think the carve outs have created a lot of interpretative issues. So if you see the number of IndAS transition facilitation group circulars which come, a majority of those topics are clarifications arising out of carve outs, because the rest of IndAS has a lot of history to it. All over the world, it's been implemented. There's a lot of precedence, a lot of discussion. Even if there are divergent views, those are known and accepted. But the carve outs are unique. And as we go into the presentation, you'll see why issues are coming out of the carve outs that have been made. And the second criticism has been the fact that we have had a different roadmap for now non-banking financial companies, insurance companies, and banks, and that has created a lot of practical situations. So if you've got a company on top to which India supplies, and then you have an NBFC below, the NBFC is prohibited by the Reserve Bank of India from early adopting IndAS. But because it's a subsidiary of not an NBFC, they have to present their accounts as per IndAS for them. And the institute was and the NACAS were charged with this issue. And what they clarified was, for the purpose of your statutory accounts, you cannot adopt IndAS because we haven't allowed it. But because of the group reporting and the fact that you must consolidate based on the same policies, you must present IndAS for the purpose of your for the purpose of consolidation. So in a sense, some companies got mandated to actually prepare two sets of accounts. Look at a reverse situation that's created for few companies. I would not say many, but some very significant companies in the country are hugely impacted. You have an NBFC on top, and you have a lot of companies below to whom IndAS is applicable. Now, the NBFC on top, who must consolidate, is not allowed to do IndAS. They have to do, for their statutory purposes, the what we call IGAP. So for convenience, we'll call that IGAP and IndAS. So for that, the companies who have migrated to IndAS still need to keep their feet in Indian GAAP, because for consolidation, they still need to present. So I think these are some of the transitory issues that we are facing, but all said and done, I think it's an important step forward. And I think in a few years, we won't probably remember all of this. But today, it does create some issues on transition. So what we have, what is the process of it? Is it just an accounting exercise, or what are the steps that you must take? So typically, projects that we have done to convert a company from IndAS to from Indian GAAP to IndAS has involved these four steps, and we've given some indicative timelines. That of course all depends on the preparedness, the commitment, and the resources that organizations deploy for this. I think as a good practice, what we found is if companies could identify a core team who can work on India's conversion, because it is a very involved and engaged exercise and means touching base with different parts of the organization. It works well, rather than hoping that in the day-to-day exercise, the accountants will be able to do it. It won't happen. It has to be project managed. So the first step, what we call, is an impact assessment, where a company would analyze its accounting policies, compare them with IndAS policies, and identify differences. One of the very important aspects we found is understanding existing contracts and arrangements. We pulled this out of the various activities. This is very important. In fact, very often it was realized when you read these contracts or arrangements that you probably didn't know the real economics of that arrangement, because IndAS is always a search for economic reality. So, sometimes we came up with agreements which said that there was sharing of powers, but that was not evaluated when you were assessing whether there is control or not. So it becomes very important whether you have a joint venture agreement. Sometimes even if you have a vendor agreement, you may have an embedded lease, or so if you have a job working arrangement, it might turn out that it has to be treated like a lease. Or you may have an embedded derivative if you're dealing, let's say, two Indian parties dealing with each other, but designating a part of their purchase or sale in dollars, for the purpose of hedging probably some exposure. So reading your contracts and arrangements, getting all of these together and assessing the impact is very important, and that takes a lot of time in a conversion exercise. So the result of an impact assessment is you identify the gap differences, and what are the impacts that you need to make on your financials and the systems that collect information, because you'll need a lot of new information that is there. At this point, normally you don't already quantify the differences. It's like coming out with a list of what the differences are. The next stage we call is solution development, which is to assess these differences. If there are accounting policy choices, and even though we say the gap is principle based, there are often choices which are to be made. So you make those choices, benchmark with what others in the industry are doing, because now, and of course, I think the advantage of people now who are looking at this from phase two is you'll have a lot of experience already available. What have other companies done? So if you're in FMCG, what did other FMCG companies do? If you're in infrastructure, did someone classify a renewable power arrangement as a service concession or not? So you will have a lot of experience to look at, because you don't want to be the odd one out, and if you want to be, then you must have a good reason for that. A lot of fair valuation exercise is involved. So that's also the time you identify who are the fair valuers you will work with, start making them prepared to give you fair valuation reports. At the next stage, when you go to implement, one of the most important is, and as I said, there are two steps, is for the opening balance sheet, there are a lot of choices. Preparation of an opening balance sheet, you must remember, is a one-time exercise in the lifetime of the company. That's the time you're moving into IndAS. After that, you cannot touch the opening balance sheet for changing policies or so on. You can do it for other reasons. For example, if errors and all are detected. But otherwise, the opening balance sheet is a one-time choice. And once you exercise those choices, they will stick to you for a lifetime. So that's a very important exercise. And again, you'll realize that bit later in the presentation. How do you track adjustments which are to be made outside? For the comparative year, you need to do both Indian GAAP as also IndAS. Most companies, what they did was, for the IndAS in the comparative year, they did not use the system. They did it through Excel outside the books. But for the current year, which you are under IndAS, it's best that you start capturing it through the system. And then what sort of controls you must put in place for that. And finally, of course, is preparation of the financial statements, getting all the reconciliations. What I can share with you is that people have very often underestimated the impact of presentation and disclosure, and I think Suresh will talk about this bit later. But throughout the project, it's very easy. You find the accounting policy differences, you quantify those differences, you select the policies. But one of the biggest step changes is the extent of presentation and disclosure, and it's taken several weeks after getting the numbers right to actually drop a full proper financial statements which comply with the disclosure requirements as well.
So, one of the key consideration from for smooth transition would be, leveraging on a lot of resources which are available. So there are a lot of education material on the various account IndAS standards which have been issued by ICI. So in total, there are 8 standards on which there are education materials available. So a lot of FAQs are there which have been answered. So once companies are transitioning, these materials are quite helpful. Similarly, as mentioned by Sudhir, there is a ITFG group which has been formed by ICI, and there are various questions posted before this particular committee. And they have evaluated from IndAS implication standpoint how Indian companies should apply them. So as of yesterday, 11 ITFGs have been issued, and in total they have addressed total 78 questions. So those questions would be very relevant for phase 2 companies when they are transitioning to IndAS. Apart from this, as of today, there is a guidance note available on the presentation disclosure, guidance note on IndAS compliant schedule 3. And often we have seen that when you are implementing IndAS, at times it becomes very very important and critical to understand the thought process why this particular standard requires you to do a particular thing. And that is where if one can go and read the application material or the guidance which are available in ISB. So basis of conclusion, so why they have concluded a particular thing, everything is documented along with lot of justification. So at times, it becomes quite useful to reach to a right conclusion why a particular standard requires you to do a particular thing. Apart from that, there are various model or illustrative financial statements are available on IndAS issued by various accounting firms, so one can leverage definitely on that. And for phase 2 companies, phase 1 companies can be used as a reference point. So utilization of resources would be one of the key considerations. For phase 2 listed companies, SEBI has provided various relaxation, and these relaxations are similar to what was applicable to phase 1 companies. So just to summarize, for Q1 and Q2 reporting, the deadline has been extended by 1 month. And for Q1, Q2, the previous year's corresponding quarter numbers are required to be presented. However, they have given a relaxation that it need not be reviewed or audited by the statutory auditors of the company. And the fact of the same needs to be disclosed. At the same time, it also mentions that as a management, the company needs to take a due care to make sure that it is true and fair positions are reflected in the results. And the corresponding full year's number of last year has been exempted. And similarly in quarter 2, when you're presenting, generally there is a requirement to present the balance sheet also, that has been exempted. And in quarter 3 onwards, for the comparative period, limited review or audit, as the case may be, becomes mandatory. And at that time, if the company is also presenting annual number of previous year, then that will be subjected to limited review or the audit by the auditors. So these are the relaxation given by the SEBI. What we have seen in the phase 1 companies, as a best practices, some of the leading companies have came out with a lot of presentation to make investors know what is IndAS going to impact their financial position as well as the profitability. So just to name one example, HUL, presented their first impact analysis in December 15. So much before in advance, before the implementation, before the comparative period ended. And in that presentation, they highlighted, how their, various numbers and balance sheet positions are going to change, how their segment reportings are going to look like, and what is impact on their opening balance sheet. And they did one more round when they reported first quarter to highlight how the profitability of the each comparative period is going to be impacted.
Yeah, so moving on from the project management to some of the topics that we face on the opening balance sheet. I think Narayan already alluded to this. If you see on the left, that chart reflects that which were the standards which had an impact on the companies that we studied. So on a sample of 70 companies we studied, majority of them were impacted by the accounting standard on income taxes, financial instruments, followed by property, plant and equipment, and so on. Now, what most of the companies, our experience in phase 1 has been, they did use the exemptions that were provided by IndAS 101. So this whole discussion of opening balance sheet is always with reference to accounting standard IndAS 101, which is first time adoption. That standard, its equivalent in Europe, was actually made to facilitate transition of companies into IndAS, because when you are moving or changing standards, there might be a lot of historical information which is required. So this standard was drafted originally to see how in Europe how it could be made smooth. So that's why they allow you certain options on transition. So whereas the objective is to smoothen your entry into IndAS, actually this standard gives a lot of opportunities. In fact, the way I would describe it is that at times what you can achieve by the appropriate use of IndAS 101 is the impact of a court scheme without even going to court. That's the kind of restructuring that you can do on your balance sheet, and you will see examples of that. Some of the considerations when you restructure that balance sheet are that if you raise your net worth too much, then your return on capital employed is impacted. So should you really raise your net worth? Because you have an opportunity, for example, to fair value land. So if you want a stronger balance sheet, your balance sheet is not looking too good, and you say, let's take the option of fair valuation, then it impacts your return on capital employed. So some of those decisions that you need to make. And also, one point I just would like to leave as I think it's now well concluded, but it's important to remember. So if you are a phase two company, you are applying it for 1st April 17 to 31st March 18. Your opening balance sheet is 1st of April 2016, and the comparative period is 16-17. Now, the opening balance sheet that is prepared as of 1st of April 2016 does not achieve finality until the accounts of March 18 will be signed. Okay, now that's, I think, an important point to remember. What happened in phase one is there was lot of lack of clarity on the tax implications that would arise of the options that were selected. There was some risk that we would be charged MAT for the revaluation of property done on the first day. And so many companies said, look, what do we do? Because there is a lack of clarity. So we assured our clients, and I think that position is quite validated, is that you can keep changing your options till March 18 accounts are signed. That's when it is finally supposed to be done. Until then, the numbers remain provisional. So if you see also some of the quarterly reportings that companies made, they have put notes to the extent to indicate that the opening balance sheet and the quarterly numbers are subject to change and will be finalized only when the audited financial statements, the first audited financial statements under IndAS are signed. So I think that's something you can remember. And if there for some reasons you want to make a change, then it is possible to do until the March 18 accounts get signed off. After that, that gets frozen as a balance sheet over here.
Yeah, so amongst the various exemptions, what is applicable, this is one of the critical ones, deemed cost for property, plant and equipment and intangible assets. So with the implementation of Schedule 2, using the concept of useful life and doing componentization, that was step in that direction of IndAS implementation. So there are, two options which is available in the IFRS standard. The third option, which is their previous gap carrying value, this is a carve out for, to facilitate smooth transition for Indian company. So the first option, which is a general rule that all IFRS standards should be retrospectively applied. So, with the if any company having objective of, doing a fundraising in overseas market, they want to remain as closer to IFRS to the extent possible. And it also provided that, select items or all of the plant and machineries can be fair valued, and on the date of transition, that fair value will be treated as a deemed cost. So the new life actually starts from that day onwards. And the third option was, India specific, as I mentioned. The way they drafted that, and it was mentioned that if you're opting for this item, then this should be applicable for all the items of property, plant, and equipment. And that has created a lot of issues, for various companies. Let's say, for example, company wanted to apply previous gap carrying value for property, plant, and equipment, but because of that reason, they were unable to do a fair valuation of land and building if they intend to. And this matter got clarified by ITFG as well. Recently, Institute realized this, and after discussion, there is a exposure draft which has been out, and it says that if the previous gap carrying value option has been applied, then it should be applicable for that particular class of asset. So for example, property, plant and equipment, you can be at carrying value. For rest of items, you can do a fair valuation on a select basis. So the companies who have done a retrospective, cost implication, what we have experienced is, some of the companies have, in past have done a forex capitalization. So with the retrospective cost, IndAS cost, they have eliminated that. In some of the companies, we have seen pre-operative expenses which were capitalized that now has been decapitalized, and the corresponding change on the interest capitalization has also happened. We have seen, some of the companies like Tata Motors, Tata Steel, what they have done is, for the select item of their property, plant and equipment, they have actually done a fair valuation. So just to give you an example, Just to name, Tata Steel did upward fair valuation roughly to the tune of 24,000 crores. And like for example, Tata Motors was upward fair valuation for select item roughly around 2,600 crores. But for the other items, they had to fall in the first category, and therefore they did all the decapitalization or forex, etc., etc. So this is very critical, and one of the critical topic which got discussed extensively in phase one is that if you are following previous gap carrying value, then how your fixed asset schedule should be presented. So the deemed cost means your carrying value becomes a new gross block, and that is how it needs to be presented. And there was enough significant doubts initially which got clarified by the institute that this is how it needs to be presented. At the same time, institute has acknowledged that various companies would have done a fundraising basis their fixed assets block. So those type of companies can present the details of the original cost, etc., by way of additional information in their financial statement.
So I think on that topic of PPE, that is probably one of the most important decisions, particularly for asset-heavy companies. So whether you are in manufacturing or infrastructure, then I think that's one of the most important decisions. That do you want to reopen your block, and that's what Suresh just covered. The other important topic is around business combinations. And if you ask me, before IndAS, when people used to say, should we go for IFRS or not? I would say that amongst the two or three biggest differences between Indian GAAP and IFRS was that we did not have a good guidance on accounting for business combinations. In fact, we had no guidance. The only guidance we had was people would refer to either accounting standard 14, which was actually only to deal with mergers and amalgamations. That did not even have to be an acquisition. If a subsidiary is merging with a holding company, AS14 came into play. The standard did not have acquisition or change of control as a thought process. In AS10, there were some three lines which said that if you buy a set of assets together, then the excess price is goodwill. That was our guidance on business combinations. And we had AS21 on consolidation, which said that when you determine goodwill, it is the difference between the price you pay and the carrying value of assets and liabilities. So your goodwill was overstated and did not reflect the reality of an acquisition. So I think this is one of the biggest changes that IndAS has brought about. I think we've got now good guidance in that. But we are now on the topic of the opening balance sheet. So what was our experience on that? So you had a choice. What some companies did is they said, look, forget the past, whatever is in my books, let it remain. And you have that choice as well. But some companies said, by not reflecting my goodwill rightly, I'm running the risk of future impairment of that goodwill. And so is there a way that we can go back and change? So the standard actually allows you to go back. The rule is that if you go back in time and want to restate your business combination, all acquisitions made after that date also need to be done. So one decision point is how much back in time do we go? So if there are companies who've done lots of acquisitions, they took a call as to saying, okay, how much back in time? So if you can see that chart, Bharti went back till 1995 and said after 95 all acquisitions we will restate. Okay. Then others like United Phosphorus, that's UPL 2005, Tata Chemicals 2007, Cipla did from 2013. What is the objective of this restatement? The objective is simple. You bring down the goodwill, which was determined at the point of acquisition. You reassign the value which was sitting into goodwill into uplifting either tangible assets or intangible assets, because though that's where the allocation of price goes. Essentially, you do a purchase price allocation. So if you have, let's say, a pharmaceutical company which has gone and made an acquisition, then they will apportion a part of that value of goodwill into probably the drug portfolio, or the brands that they have acquired through that acquisition, which then is an amortizable asset. So for example, if you go in 2005 and you identify an intangible asset with a life of 20 years, we can actually take from 2005 to 2017, 12 years of amortization out into the opening balance sheet. And then you are left with some surviving value and life, but you have de-risked your opening your future P&L from any impairment charge that is there. So this is a very engaged exercise. What it meant in many of these companies was a lot of discussions to understand what was the reality of the acquisition, why did you pay that price, and what is the intangible. And then you must go without hindsight back to that point of time and get a valuation done. So you have to identify a valuer who will say, I will close my eyes to what happened after 1995. And in 95, what was the mindset of the company when they made the acquisition? And I will assign value to that intangible at that point of time. So that's what exercise is required to be done. And of course, in making this decision, a lot of lot of dynamics are in play. One of the dynamics is also what will be my future impairment, because what has happened is goodwill will not be amortized. So if you decide to go with the option that you want to leave the goodwill as it is, you say I don't want to restate, let me just leave my financials as they are. In the future when I make an acquisition, I'll apply this, because in the future you don't have a choice. So in that case, the goodwill stays on your books. It does not get amortized. Under IndAS, there is no provision for that. But the risk is that you may run a risk of impairment on that. So that is one choice. But if you decide that no, let me apportion the values into tangible assets and intangible assets, then you will have an amortization or a depreciation charge coming into the P&L. So there is a balancing to be done or decision to be made as to what would you like to do. So that's one of the, I think, important issues around this.
So this is also one of the significant exemption which is available, and this is applicable for the standalone financial statement. So for the investment in subsidiary, associates, and joint venture, IndAS says that these investments can be carried at cost, or it can be accounted in accordance with IndAS 109. That means they can be fair valued as a accounting policy choice. So if company has opted, let's say, to keep these investments at cost, then what should be the cost on the opening date? So there is a concept of a deemed cost, and there are two options available. Either you can have fair value on the date of transition, or whatever is the previous GAAP carrying value, that can be treated as a cost. What we have seen in this particular case, like three companies, okay, Bharti, Cipla, and Tata Steel, they did a fair valuation on the date of transition, and in some cases we have seen either there is an increase, and in most cases we have seen there is a decrease. So again, just to quote a number, in case of Tata Steel, they have done a downward fair valuation of their investment in subsidiary to the tune of 47,000 crores, which is around 72% of their net worth as on opening balance sheet date. Okay. Similarly, for other companies also, they have done a downward fair valuation impact. And some of the companies, where they have set previous GAAP carrying value. So in the previous GAAP, there was, let's say, cost and less provision for permanent diminution in the value of investment. The moment you're saying previous GAAP carrying value, whatever impairment was taken in the past, that identity is lost. That means in the future, those impairments cannot be reversed. So the net number becomes the new cost for the investment. And some of the companies we have seen, they have kept at cost as it is what was there in their Indian GAAP. Yeah. Yeah. Through retained earning. Retained earning. On day one, all the adjustments. Yeah, day one.
One of the challenges that you face when you do the fair valuation is a question you ask yourself is, look, I was certifying all along that it was fine to carry it at this value, and now I'm doing a fair valuation and bringing the number down. So how do you reconcile the AS 13 view that there was no diminution other than temporary with the fair valuation? So as if you use the word permanent, so you say that I was looking for permanent, this is fair value today. So I mean, of course, I've said it with bit flippant, but the fact is we do believe that there is a difference between the valuation principle of fair value on date of transition and the evaluation that we did under AS 13. So I think they are two different concepts, and therefore there is a justification of what these companies have done. But this is, I know, it's a question which often comes in the minds of companies, their boards, to say, hey, all of us, all these years I was carrying this. Now you're saying fair value down by so much. So there's a bit of a mental dilemma, I guess, at that time. Okay, so those were some of the big topics relating to the opening balance sheet, decisions on the opening balance sheet, carrying the property, plant, and equipment, restating acquisitions, and the fair valuation of investments at the point of transition. Let's look at some of the ongoing implementation issues. Of course, this topic, which I'm just going to touch on, is equally relevant for the opening, and this is the concept of change in control. The whole definition of control has changed. If I go back to the history, and I was involved a little bit with the institute when AS 21, 23, and 27 were being made. More, I got involved when 27 was made. I was with that standard. And question on was, what is control? And the Companies Act always has defined control in a very clear manner to say more than majority ownership or composition, or you control the composition of the board. And the institute was inclined, and there were a lot of members on the ASB who felt that the right way to define control is to say that if you own more than 50%, then you cannot say it's a joint venture or something. It has to be treated as a subsidiary. So that's why if you see our many joint ventures, if you have a majority owned joint venture, if I put it that way, then it was treated like a subsidiary. So control was defined in a very what I would call you've got a bright line. More than 50% you have control, and people got around all this by doing all sorts of agreements. So you give someone, say, oh, here's, I mean, just to exaggerate, you can take 90% of equity, and you say, give the other party the right to run the day-to-day operations. So by agreement, so you still consolidate. And if that party is a foreign party and doing IFRS, they could also consolidate. So we had this strange situation that two companies can actually consolidate the same operation. In IFRS, that is unthinkable. In fact, at times, if you have a doubt that who should consolidate, if I was an auditor, I would actually ask them, get me a confirmation from the other party that he's not consolidating. We cannot have a situation that both parties are consolidating. Now, what's important in the case of determining control is to understand what is the nature of rights and powers that have been shared. And so now that's the concept that has come. Mere ownership or majority ownership is not sufficient to demonstrate that you control. And that is why you need to read agreements carefully in the context of a conversion. Wherever you have relationships through the entire investment schedule, my question to the companies would be, as I convert, do you have any agreement other than your shareholding? Let's study what that agreement is. What are the powers that are shared? Some of the, this is, as I said, important both on transition, and I think we have one example here of L&T. L&T has in their IndAS stated that they are now treating some companies which were earlier their subsidiaries as joint ventures, and I assume that they must have earlier had a majority ownership, but they must have a joint venture with another party. So there is actually a sharing of control. So the equity holding pattern doesn't reflect the fact that they control that entity. And then you have, I think, HUL, which has added a foundation into the control definition and so on. So some of the topics which, in fact, this is another topic where we keep getting asked for advice. Since this IndAS has been rolled out, anytime someone's doing a transaction, they say, what are those powers that we should give up? And I found 2 or 3, if I give you examples in these agreements you have, sometimes it is the power for approval of the annual budget. So you have two parties who come together, one owns 60%, other owns 40%. But the 40% party also has a right to comment on the budget. Now, question is, if they have that power, is that sufficient for you to say it's a joint operation? Or are you saying that's not important and therefore it's a subsidiary because I own 60%? And the answer, as always, is it depends. It depends on the level of that annual operating plan. If I put it to you in a different way, and it's a bit counterintuitive, the smaller the power someone has, or on smaller topics, if someone has power, the more likely it is that that party is eligible to control. So if it's a big topic, then it's seen to be a protective right. So, for example, you say, if you are going to shut down your factory, then you need my approval. Okay, that's one possible right. The other is you're saying, I'm going to buy a machinery worth 1 lakh rupees, and that I need my approval. If you have the right to prevent him from shutting down the factory, that is likely to be what is called a protective right, and that is not a test of control. But the person who has the right to say, I will stop you from putting up a 1 lakh machine, let's say in a big enterprise, he possibly has control because that's a participative right. So, in a very general way, if I put it, the smaller that right, which is because what you're looking for is can they control the operations? Are they participating or are they only protecting their interest? So, the right to appoint auditor, it doesn't make a difference. It is not one of the key activities. So you have to define as per the standard what are the key activities which really run the company and who has the rights on those. So that's why if the annual operating plan is a very detailed plan and there are some consequences of not complying with that, then possibly it's participative. Otherwise, possibly it's not a participative right. Appointment on CEO, CFO. That's most likely if someone has the right to appoint CEO or CFO, that party is most likely to be in control. And if it's a joint decision, then both don't control. So there are these few situations you need to analyze the powers carefully, and you need to see in balance who is the party which is controlling.
Yeah. This is, one of the significant standard in India because earlier there was no corresponding standard. So before, I start this topic, let me give you just some background. This standard IFRS 9, this in India it is 109. This has gone significant revision post financial crisis in 2008. And this was ISB FASB's joint project, and to most uh, extent, both these standards are aligned, but there are some differences. Like the impairment model suggested in IFRS is different as compared to what FASB recommended. Okay. And when we were implementing this particular standard, almost in every company we will see this particular standard has impacted various line items of balance sheet. Like, let's say if there are no adjustment in any particular company, but the classification of assets into financial asset, non-financial asset, classification of liabilities into financial liabilities and other liability, at times that is also a judgmental, so one has to go and read the definition of these financial assets and liability to determine how this needs to be presented in the balance sheet. So one of the topic which has been discussed extensively is the classification of a particular instrument, whether it is a debt or a equity instrument. So just to put it simply, that the standard says for any instrument which is a convertible instrument, for it to classify it as a equity, two conditions which are very critical needs to be satisfied. That it should be for fixed amount and for fixed number of shares, and often it is called as fixed to fixed criteria. So if fixed to fixed criteria is satisfied, then a particular instrument will classify as equity. Now, we have just put it some example that, in these companies, like, preference share capital, which was often part of, your net worth, disclosed under share capital. In some of the companies, there is a split accounting which has been done. So some part has gone in equity, some part has gone in equity. In majority of companies, we have seen, it has entirely become a liability. And like, often we have seen that, the holding company does the funding to subsidiaries, and, and the amount is payable at the discretion of subsidiary. And that has been evaluated whether it will be a perpetual debt. And if it is a perpetual debt, what accounting needs to be done. So if the amount is repayable back to the parent company solely at the discretion of SPV or a subsidiary company, then that particular instrument or the amount can be classified as a equity, and the related expenses which are there, then that can be treated as an appropriation. So like, in case of two Tata companies, we have seen they have disclosed perpetual loans as a equity instrument. And in, many companies we have seen that, mainly in infra and other companies, that, a lot of times the parent company gives interest free loan to subsidiary companies. Now the loan given will be a financial asset which needs to be, reflected at fair value on day one. And if it is a interest free loan, then basically over the tenure of the loan, the discounting needs to be done. And when you do a discounting in the parent's books, that whatever is, suppose it's a 100 crore loan which you have given for 10 years and the discounted value, for example, is 60 crores. What is that 40 crore representing? It's like that 40 crore is an additional investment made in the subsidiary, and that should be added to the cost of investment. Now, this has created various challenges for a lot of companies from a MAT perspective on this particular topic, and this was a significant topic. So just to highlight, Raymond specifically mentioned in their annual report saying that, their investment in the preference shares of subsidiaries and debenture, the terms were amended with effect from 1st April 2015, which is the opening balance sheet date, to make this instrument as a compulsorily convertible instrument, so that this gets classified as equity and there is no accounting implication. Another topic was, the accounting of financial guarantee, and this is only applicable in the standalone. So often parent company will give guarantee to the subsidiary company for its loan taken, and that requires a separate accounting in the standalone balance sheet of both subsidiary as well as the parent company. And this financial guarantee needs to be measured at fair value. Now, what we have seen is that, the main test to assess that what is the fair value of the guarantee, that with guarantee or without the guarantee, what is the interest that subsidiary has to bond. So let's say with interest with guarantee it is 10%, without guarantee it could be 11%. So the 1% saving what subsidiary is making, that is effectively a fair value of guarantee. Again, in the parent company books, you will fair value this, reflect as a liability, and if you're not recovering any amount from subsidiary, then this is treated as an investment in your subsidiary. It will be added to the cost of investment. And similarly, the mirror accounting will happen in the subsidiaries books. So subsidiary will show it as a equity contribution from the parent. Now there is one topic which one has to analyze, that sometimes these guarantees from a subsidiary standpoint can be treated as integral part of the loan. Like if the loan were to assign to some other lender from the existing lender, and if the loan will move along with the guarantee, then one can interpret that the guarantee is an integral part of the loan, and the amount which is reflected in the balance sheet, that includes the value of both borrowing as well as the guarantee. So you can avoid accounting at subsidiary level. But the same mirror accounting in the parent's books is not true whether it is an integral part or not. So in the parent company's books, accounting of financial guarantee contract is must. Similarly, we have seen that, drawn amount versus undrawn amount. So for example, the parent has given guarantee of 1000 crore, but subsidiary has done a withdrawal of only 500 crores. In that case, how do you value the guarantee amount? Whether you will keep base of 1000 crore or 500 crores? Again, it's a topic of debate and interpretation. One view we have seen that, you can consider only 500 because at that point in time, subsidiary is utilizing benefit of only 500 crores and the valuation should be based on 500. But one may argue that, I have open obligation for 1000 crore and subsidiary may draw the additional 500 over a period in next 2 to 3 years, then I may value. So this is again an interpretation, and each case needs to be evaluated how it should be reflected. There are two tests which one has to meet to determine how that particular instrument will be subsequently measured in the company's balance sheet. And what are the two tests? One is the business model test, whether it is company's business model to hold a particular instrument till its maturity, and whether the contractual cash flow, principal as well as interest, whether these are fixed. If these are fixed, then that particular instrument can be carried at amortized cost, or else there would be a mandatorily fair valuation which would be required. And similarly, in case of equity instrument, in case of equity, because you're carrying equity risk in a particular company, the contractual cash flow test will never be met, and therefore standard says such instrument needs to be mandatorily fair valued. It provides option that the fair valuation difference, either you can take it to P&L or you can elect to take it to other comprehensive income. So suppose company has elected to take it to other comprehensive income, it remains there forever. Even if the investments are sold subsequently, it cannot be recycled to P&L. And we have seen challenge in this particular area. If there is a unquoted equity instrument, how do you determine the fair value? In the earlier standard, there was exception which was provided that the unquoted equity instrument can be kept at cost but there is no such guidance. So fair valuation is mandatory. However, standard also acknowledge that at times you may not have sufficient recent information for unquoted investment to determine its fair value, and there could be a possible range of fair value, and if the cost represents the approximate fair value, you can continue to keep it at cost. So there is some guidance which is there in this particular standard. Another big topic arising from this is the expected credit loss. So we have always heard this concept of provision for doubtful debts, and often while finalizing the balance sheet, we have discussed with the companies that whether the provision for doubtful debt is appropriate or not. This standard says that as the moment you book the sale, you have to book the expected credit loss for particular debtor. So a lot of time has been spent on this particular topic in phase one, because India is the first country in the world who is implementing this particular standard. So there is no global precedence available on this. The luckily for phase one companies, banking and insurance company and NBFCs were out, because this particular model will impact those type of companies significantly. And in case of manufacturing and other company, there is a simplified approach which has been suggested by the standard. So ECL model, basically the provisioning is required for credit loss as well as for the time value of money. If there is a delay expected, then you consider that in your model and provide for it. In this particular, a lot of companies have gone about, developing their model based on the historical bad debt history of that particular company and for a particular business. So it should be done for each. If there are different businesses within the company, this needs to be done for each of the different segments. So I recollect, having gone through L&T's presentation, investor presentation, they have done a, quite detailed slides on how they've gone about doing ECL provision. So often, we have discussed in the past that, if the receivables are from government, okay, there is no provision required. But, in that case, there might not be a credit loss, but time value of money should be factored in that calculation. And another interesting topic, we have seen that in case of project companies, if there are unbilled receivables, the amount is not yet billed, whether ECL provision is required for that. And if we read the standard carefully, the unbilled revenue would also be treated as a financial asset, and therefore the provisioning for unbilled revenue is also required. Another topic what we have encountered is derecognition of financial asset. Now, often various topics are principle based. This is one topic in IFRS which is entirely rule based. So one has to pass that particular test, that what is the risk and reward before the securitization, and what is the risk and reward companies retaining after the securitization. One has to pass that test, and if the company concludes that significant risk and reward has been passed on and there is no recourse available, they can strike off that particular financial asset from their balance sheet. So typically, bill discounting, what we have seen that bill discounting was done by a lot of company, and there is a recourse available to the company. So a lot of Indian companies under Indian GAAP, they have derecognized those financial asset debtors and disclosed that as a contingent liability. Now what will happen is the debtors will remain as it is, and whatever amount has been received by discounting, that will appear under borrowing schedule. And this also requires extensive disclosure for any derecognition which has happened in the balance sheet. Yeah. So I am not too sure on how it is going to impact, but whatever I've read, the RBI has taken a lot of initiative and a lot of provisioning norms have been prescribed so that the banks can take the impact in a staggered manner rather than taking the one-time impact when the standard will be implemented. And yeah, and what I understand, that was one of the reason, while finalizing the roadmap, why banks, NBFCs, and insurance companies were kept outside of the first roadmap, because this standard was expected to impact significantly the financial institution industry. Yeah, yeah, letter from the bank. Yeah.
So on this, yeah, a lot of companies wanted advice as to how do we avoid this interest-free discounting or advances that we have given. And I think you have to see whether you can achieve an equity classification. So, for example, if you put the repayment on the borrower, to say that they will repay at their discretion, then you may probably be able to change its classification, into, yeah, from debt to equity. So you have to evaluate the conditions and see how you can change the conditions from, like if you're saying it's on call, then, you are able to draw it sometime. But you say, no, I will not be able to call it. So I think you have to find different ways to reach equity classification over there. Yeah.
Where it's at the discretion of the company. Of course, by virtue of the Companies Act, it cannot be held for, it cannot be issued for more than 20 years. So, because of the discretion available with the subsidiary company, can you still say that there could be a equity component in the preference for the it's a redeemable preference, but
Yeah, so if it is a redeemable, then it will be straight away classified as a liability.
The roadmap for NBFC has been already specified. I just wanted to clarify for one of the NBFC. I mean, the stockbroking company, it has been specified in the March circular that it is deemed to be an NBFC because NBFC is not a registered, the stockbroking company is not required to be registered with RBI, but for all practical purposes, it is treated as an NBFC and an inclusive definition has been given. So, a stockbroking company which is listed on the stock exchange will not be required to follow the IndAS in the second phase also. Yeah, because the insurance, there is an inclusive definition given in the March 16 circular, which says that NBFCs would also include the AMC companies, insurance companies, and other companies, which are not strictly the NBFC companies, but an inclusive definition has been given. Right, section 45, which is over there, 45I.
Yeah. Yeah. So another area which has impacted significantly is deferred taxation. And globally, we have seen this is one of the complex topic, and this is also one of the reason of restatement in some of the global companies. So this topic needs to be, carefully assessed, and deferred tax often becomes complex. So this IndAS follows balance sheet approach rather than income statement approach what we have currently under Indian GAAP. And in case of unabsorbed depreciation and carried forward losses, the rigor under Indian GAAP is more stringent currently for recognition of DTA. In IndAS, it only requires whether it is a probable or a reasonable certainty whether this asset will be realized or not. So this is one area where we can say that, in IndAS, there could be a more recognition of deferred tax asset because the threshold for recognition has been reduced. And all the transition adjustment, what you make in your balance sheet, the corresponding deferred tax impact needs to be provided for. And the presentation, of deferred tax is like your mobile phone network. So wherever you go, it follows. So if the item is going in P&L, the corresponding deferred tax will go in P&L. Similarly, if it is going in OCI, it will go in OCI. And if it is a equity item, deferred tax should go in equity. In the consolidated balance sheet, when you do consolidation under Indian GAAP, it was only line by line aggregation of tax expense of all companies which were consolidated. That is how it was presented. Now it requires a separate calculation of the deferred tax. See, all the adjustment entries, which has impact on the balance sheet or the profit and loss account, needs to be evaluated from the deferred tax perspective. So one of the example is stock reserve. So what used to happen in Indian GAAP, we used to eliminate the unrealized profit, but on that profit, whatever was the tax charge, that used to remain in the P&L. So the tax charge was more and the profit was lower. Now deferred tax the IndAS requires you to create a corresponding deferred tax asset, and the rule here is it should be destination country tax rate which needs to be used. And this also, at times create fluctuation. So for example, if some company has exported from India and they've paid 33% tax on that, and it is lying, let's say, in a country where the tax rate is 20%, then the DTA will be recognized only to the extent of 20%. And if it is a higher tax paying jurisdiction, then the credit will be more. So this at times, depending where your stock lies, could create a significant impact in the P&L. Another topic is that undistributed profit of subsidiary, associates and joint venture, the corresponding deferred tax liability needs to be created. So whatever will be the tax consequences when a subsidiary, associate and JV distributes dividend, that one has to consider and create a corresponding liability on that. So in case of subsidiaries, what standard says is that, if the company is controlling the dividend policy of the company and it is not expected that in foreseeable future dividend will be declared by that company, then one can avoid recognizing deferred tax liability. However, this needs to be presented and disclosed in the financial statement. So it is always very easy to say that in case of subsidiary you are controlling the dividend policy, but at times it will be challenging for joint venture and associate. If unanimous consent is not required for declaring dividend, then in case of JVs and associate, whatever undistributed profits are there, deferred tax liability needs to be created. And there are various companies in India also, we have seen they have recognized DTL on the undistributed profits of subsidiary companies. And this standard also requires extensive disclosure, right? Effective tax rate reconciliation needs to be presented. So what is the statutory rate and what is the effective tax rate? The RICO has to be given, and it becomes complex when the company operates in a multiple geographies with the different tax structure. So the question is that in those cases, how the reconciliation should be presented. Standard gives two options. Either you can keep the parent company tax rate as a base to give a reconciliation, or you can calculate what is a group's weighted average tax rate and then give the reconciliation. We have studied some of the Indian companies' balance sheet, and most of the Indian companies have preferred to keep Indian statutory tax rate as a base for giving that particular reconciliation. Another disclosure is the utilization of deferred tax asset on tax losses and unrecognized DTA if are there, that needs to be disclosed in the financial statement.
Maybe I can add my bit to the deferred tax as well. One of the other topics we considered in a lot of conversions was whether you need to create a deferred tax asset on the indexation of land. Because as you have land and indexation increases the tax base of the land value, so should you create? So the institute has given a ITFG on that, because which does not require you to do it until you're sure that it is actually going to be sold, because otherwise they're saying we're not sure about the use. If it goes in a slump sale, then it may not get indexation benefit and so on. So there's an analysis in the ITFG on that topic. Coming to revenue recognition, I'll run through this quickly. I think just 2 or 3 points. I think excise is now well known in the IndAS. Excise being a tax on manufacture on the company was grossed up. Unfortunately, post GST, it will go out, and therefore many consumer companies will be hugely impacted. Their turnover will drop all of a sudden. First, you gross the excise, and next year now with GST, you don't have excise. And GST is you're acting as an agent, so it will not go into the top line. So that is going to be an impact. Also, consumer companies were significantly impacted by the presentation for some of the rebates and discounts. So already in the earlier gap also, trade discounts were being netted off, but cash discounts were not being netted off. And I think another concept coming is you have to show the fair value of consideration. So anything you give to a customer, even by way of kind, gifts in kind, and any schemes you're running, those need to be netted off. So this, the application of IndAS has had a huge impact on the top line of consumer companies or companies which give these schemes. So you have over there is an example that I think this is from Hindustan Lever. In their presentation, they said their turnover was impacted by almost 962 crores because of the change or reclassification that they did. The other topic I'll spend a minute on is EPCG. And on export promotion guarantee, there's quite a change in the accounting, and I feel this actually more reflects the economic reality. What you would do in the case of a EPG scheme, historically, what companies have been doing is they've been showing this as a contingent liability. So you book the asset net of the customs duty benefit that you took, and whatever obligation is left, you keep reflecting it as a note to the accounts. I think this will change. In IndAS, what they see is that versus grants are presented as deferred income, you don't net them from assets. So in the case of EPCG, you would actually record the asset gross and create a corresponding duty liability. Okay, because you're saying that why did I get this duty saving? I bought the asset, the cost of the asset is gross, and of course I have a liability for duty. And how do you settle that liability? They have given you two choices how to release. This is like a government grant. And there are two choices. If you feel that this grant is to incentivize you to acquire the asset, then you can release it along with the depreciation. So you have depreciation debit and you have a release parallelly of this. But I think a better accounting, and we have seen, I think 2 or 3 companies actually do that, is you take the credit based on the export obligation being met. And that's the different thinking, I think, that IndAS is bringing, because the other accounting, if you take as per the life, was also the same effect we had earlier, because you had recorded net, so automatically your depreciation charge was lower. So if I was buying an asset with a 20-year life, I was reflecting the benefit of the EPCG scheme in a sense over 20 years by lower depreciation charge. Whereas if you now correlate it to the export obligation, which the ITFG has also allowed, then if you have met your export obligation in 5 years, you can actually release the EPCG duty liability into P&L in 5 years, and you still have an asset which is stated gross, so your balance sheet is that way better. So that's the change, I think, on the accounting for EPCG commitments.
Yeah. So presentation and disclosure, it sounds very simple, but when companies have implemented, there's a lot of time spent on this particular topic. And and if we can, just see for some top companies, the number of pages of their financial statement under IndAS has increased significantly. So the quantum of disclosure which is required in the IndAS balance sheet is significant. And I'll just share some of the key disclosure requirements. So financial instrument, as we discussed, is a key topic from a measurement and recognition perspective. It is also one of the major topic from a disclosure standpoint. Business combination and consolidation, of course, if you have that, it requires certain disclosure, which needs to be planned thoroughly. Effective tax reconciliation we just discussed, and key estimates and judgments. So there are various key estimates and judgments one makes in preparation of financial statement. Now that is required to be disclosed in the financial statement. Operating segment, what we have seen also has created impact in some of the company. We have one slide on that we can discuss. And the related party, if there are change in the control assessment, additional parties got added, and the whole reconciliation statement. So when you're preparing, your opening balance sheet, there are reconciliation statements which are required. So those also needs to be presented. This year, a lot of companies, spend significant time on this because for balance sheet items, it is 3 years data which is required to be presented in the balance sheet. So early planning and making sure that company has the relevant information for disclosure which is required is a very very critical. So let's say for a March year end client, if they are able to achieve the 2 years data opening balance sheet as well as comparative by December, then they will not they'll be able to save their time at the year end. Operating segment, earlier under Indian GAAP, based on the risk and reward of a particular business segment or a business component, segment identification was done. Now, IndAS is changing this concept, and this is more like a management approach. So, one has to identify who is the chief operating decision maker in a business for a business component, and how they are reviewing those particular business, how decisions are made in the company, and accordingly segment information needs to be presented. And standard also says that the kind of, let's say, MIS whatever gets presented to CODM, in the similar manner the segment reporting needs to be done with the reconciliation to the financial statement. So just to quickly summarize, for some of the companies who are not reporting segment, started reporting segment under IndAS. For some of the companies, segment reporting reduced, and for some of the companies, segment reporting, reportable segment increased. But most of the companies, by and large, they have continued with the same segment reporting.
So what are you saying in case of Godrej consumer products,
Yeah,
NDS, four additional segments were
yeah, yeah,
additional four segments.
yes.
So basically
So
covered
they,
MIS is reported.
right, right.
In fact, the standard requires you to reconcile the MIS to the numbers as well. You should show as per MIS and then reconcile to the profit and loss. So what companies have done is they have now become careful as to what you have to show in the MIS because that is almost going out. So if you are debiting notional, let's say, interest charge in the MIS, then even that you should actually charge because that's how you are viewing that.
Yeah, so this financial instrument I spoke about, some of the aspects what is required to be disclosed is in an entire fair value for financial asset and liability which are carried at amortized cost. Even for those assets and liability, fair value disclosure is mandatory in the financial statement. And
Suresh will probably go through this
yeah,
topic by itself.
yeah, and
How many pages have you put on this?
yeah, so around 10-12 pages in financial statements have gone on this particular topic. And this, I would say that this has to be company specific. So every company needs to study what should go in their, capital management policy, the liquidity risk, the price risk, and it also requires you to give sensitivity analysis that if interest changes, how much impact could be on the P&L as well as on equity. So this is one of the significant topic. And the most common reconciliation, what we have seen, the most of the items we have already discussed in our presentation already. Proposed dividend is one item, now it is required to be recognized only on the shareholders' approval. And another item,
Sample that we studied, the net worth of the sample went up by 30,000 crores because proposed dividend was reversed.
so another topic which we have not covered as a separate topic, but ESOP in some companies have also has a significant impact on P&L. So in case of ITC, impact was as high as 550 crores.
So I think, in the interest of time, I'll not present this right now. Let's see in the Q&A because the code scheme topic is by itself. I think how you should deal with it. But I'll skip this for the moment. If we have time in this, will come. And on the standards that are issued, now this is, I will again say, is a bit of a, I would say, criticism. When in Europe they came up with IFRS and they said European Union countries should converge. They offered corporates what is called a stable platform which means they said once you implement for the next 2 to 3 years, we will not announce any new accounting standards to kind of let companies absorb and be stable. IFRS 115 or IndAS 115, equivalent of IFRS 15, which is revenue recognition standard, is going to bring a fundamental change in revenue recognition for many companies. It is currently proposed that that standard will become mandatory on 1st of April 2018, 1 year after phase 2 companies will have just implemented IndAS. And you also have to restate comparative. So in a sense, phase 2 companies must already prepare for what is going to come. First, they must learn the new RevRec standards and all that is there, and then say, oh, this is also going to change next year, and I'm going to do this year again. In my view, it's a bit unfair. 115 was pushed already, but I think if the application is going to be the way it's proposed, then probably time should also be given to phase 2 companies to then implement it 1 year later, because otherwise you're next year already going to implement, and this is a major standard. We are actually doing projects on 115, to say how companies should change their systems. It will have major impact on companies like telecom companies, infra companies, airlines on implementation of 115. So I think hopefully, through again BCA, we should probably try to represent that 115, there should be more time for application of this. Similarly, the leaser standard, of course, that's in 19. So these are some of the things that are coming. Very quickly, best practices. Don't treat it only as an accounting exercise. Many companies treat it as accounting. As you saw, there's a lot you can achieve in your balance sheet by doing IndAS carefully. Good project management. Try to put as much into the system as possible. Trying to keep track manually will be very difficult. You can do it for 1 year, but you can't sustain this. So I think that would be the other suggestion. Investor communication, prepare your stakeholders early. If you're listed, prepare your board early. So in many of the companies, we have already been presenting through the quarters what IndAS will be, even before it was put out, so that board members and audit committee members became familiar with what IndAS numbers would look like. And similarly, like you saw Hindustan Lever, I think that's the best practice. They actually put their opening balance sheet and a detailed statement out saying that, look, this is likely to be the impact of IndAS. So few companies did that. And the thing which you can't emphasize enough is training. I think it's very important to train people, and not only in the finance department, but also outside finance. I know one company where there was someone sitting in one department. He was sitting on a very valuable right, which he didn't disclose to anyone. And later on we realized, we said they should have been accounted as an intangible. So I think even the contracts, very often you have contracts which different parts are entering into, like for procurement, they do job work type arrangements, but they will maybe not give you the agreement. When you see the agreement, you say, hey, this looks like we actually own those assets because we control every part of that operation. It's like a cost plus operation. You've guaranteed the procurement, you're only booking the bills. But when you read the agreement, it's a cost plus arrangement where you're saying everything you incur, I will see that I'll true up my purchases by giving you the difference of your under recovery, So essentially that. So I think these are very important, that the different parts of the business understand sensitivity of what contracting you are doing, and what the implications of that can be. So I'll stop there. We have some time for Q&A. I think 5-6 minutes. Yeah.
We can have 4 or 5 questions. Jubil, you have the question on your mind. Let others also hear your question.
One confusion which is there now, this deemed cost on a fair value basis for selective items. Now, suppose there is a company has 3 different parcels of land. Can they fair value only one parcel of land and not the other 2? What is really considered a selective fair valuation? Because I believe that the ETFG has given a view that if you even follow the deemed cost as the fair value, you need to do it for an entire class of assets, which seems to be in contradiction to what is actually there in IndAS 101. So what is your view on that?
I think there are 2 approaches. One is what I would call the IFRS compliant approach, and one is the carve out, which was given that you can take the Indian GAAP carrying value. I think the ITFG is in the context of the Indian gap carrying value.
No, so we can continue to still
Yeah.
do a selective fair
Yeah,
value.
so I'm coming to that. So under the IFRS compliant option, you can go item by item. You can actually pick up one piece of land and do it under the IFRS compliant.
So that is also permissible.
Yes, yes, because it says an item in that.
The other question, if I just one more now, in this case of some of these foundations which are there, which companies have started consolidating, still can you not take the view that there will be no economic benefits
Yeah.
which will flow, so we need not consolidate? Which is what is the view which we were taking earlier. That can also still hold.
I think that view can be evaluated. So I would not rule that out. You will have to see whether there is any possible flow back, no flow back. You're saying there's no flow back or benefits to the enterprise. Sometimes this is one-way traffic. You
No,
only
because
consider-
legally, I think if it is a Section 8 company, there cannot be a
Yeah.
flow back benefit.
Yeah.
So according to me, we should still not continue to
I think that
consolidate
view
them.
is possible. Yeah.
Sir, probably we have not discussed one of the most important adjustment which has been found in all the balance sheet is processing fees and the borrowings. The adjustment of the processing fees and the borrowing, because it is found to be adjusted in every balance sheet that we have found. Only a small question on the same subject, that the processing fee which has been expensed out in connection with a long-term borrowing will only get adjusted. But the short-term borrowing, say for example cash credit limits or the current maturities of the long-term debt, now the processing fee relating to the same is not required to be adjusted.
Yeah, you're right. So in case of short-term borrowings, it will immediately go in P&L because short-term.
It's only one term,
Yeah,
1 year.
Yeah. In case of long-term, it needs to be factored in the EIR calculation.
Effective interest rate
Yeah,
method.
effective interest.
Okay.
method.
So, another two topics I think probably we can, for the benefit of the members, is excise duty presentation and the actual valuation. Actual valuation figures, I mean, the whatever that actually gives the figure, this straight away is required to be adjusted into the financials.
Yeah. So on the presentation of excise duty, why that view has been taken, because companies playing a role of principal, that company has to collect the excise, pay the excise duty as in principal. They are not acting as an agent. So like sales tax and on GST, what is going to happen is company will collect that tax from customers on behalf of the government and deposit, and therefore in GST, it will be net of GST, and excise currently companies are presenting on a gross basis.
Right, sir. The only last question is about the amortization of the goodwill. That was a case that was presented over here, and you also cited the example of UPL. Now, recently, about just 2 days back, only UPL has come out with a result saying that the amortization of goodwill has been continued because it was sanctioned in the scheme earlier. So, and it is not an deductible expenditure so far as income tax is concerned. So, they are debiting into the profit and loss account. They are continuing to amortize the goodwill into the financials. And the auditors have also said that it is not in consonance with the IndAS, but they have to continue with this the practice because of the scheme approval.
So that's the slide I didn't present.
Right, sir.
So I think one of the biggest issues, which as of now there is no issued clarification, though we have spent hours discussing this in various forums, is the interplay between court schemes and IndAS. And if I take a couple of minutes, let me give a very simple example. You have a, let's give you a very simple example. You want to merge your 100% subsidiary with your parent company. Let's say very simple transaction. And you say that I will have the appointed date as 1st of April 2017. Okay, you are preparing accounts for 2017-18. If I go by the guidance on business combinations under common control, I think that's Appendix C to IndAS 103. If you have a common control business combination, you must present the accounts as if for all periods presented, this business combination had taken place. In which case, you should have merged effective 1st of April 2016, even the appointed date is 2017. Now the question is, what should you do? If you go by the court order, the appointed date, and what we have done historically, then we would have done 2017-18 only without restating the past. If I go by IndAS, I must restate the past. So we have this sort of topics we are facing in transitional situations, including the example you gave for UPL, where they had a scheme which was approved prior to IndAS coming into play. But the scheme has to be implemented when IndAS is applicable. The question is, do you follow IndAS or do you follow the court scheme? Because if I don't follow the court scheme, you run the risk of contempt of court.
Right.
And the point is that the court, when it approved, their mindset was that they were approving a scheme which is compliant with accounting standards, because at that time Indian GAAP was the applicable accounting standards. So we are in, if I may put it, a holy mess in this topic, and a safe position, like in the case I gave you of the subsidiary with the this, I think both are fine. I mean, I would be able to argue both ways. If you want to do effective 1st April 16, I will say, look, the intent is we should follow the accounting standards for the purpose of merger. If you want to do April 17, we will say we respected the court order. So you can do both. So I think this is a bit of a difficult situation. It's a transitional issue. I know that some companies are also saying, even today, let me file a scheme with appointed date earlier. That time IGAP was applicable, so that accounting auditor will certify, So there is a bit of a gray area in this. A safe position is follow the court scheme. I think the question is, does law override IndAS? I think that's not an unsafe position to take. Yeah. Yeah. Only, Zubin, my disconnect with that is that today accounting standards are also law. So why do we say that? Yeah. Why are we saying our accounting standards are subservient to the law? So I think that's why there is a bit of disconnect.
So my question is regarding disclosure of preference share. In financial year 15-16, we had issued optionally convertible preference shares, and those preference shares were converted in phased manner into equity shares in financial year 16-17. And at the end of the financial year 16-17, they were remaining preference shares were converted into redeemable preference shares, and those redeemable preference shares will be redeemed in this September period. So how do we disclose?
So for every instrument, the classification has to be determined on day one. So let's say when you said on the opening date, it was optionally convertible,
Yes.
redeemable, convertible, then accordingly the classification needs to be done. So let's say in that case, fixed to fixed criteria will not be met. And if there is because of the conversion option, if the company is getting some benefit, then only the conversion portion, there will be a split accounting which will be done. And as in when, let's say in future, the conversion happens, is actually a settlement of a liability. So the liability will be squared off, and the related components of equity, share capital or securities premium will be credited.
Okay. Thanks.
As you can see, I've got a handicap on financial instruments.
Thank you. The topic was so heavy to work out and very difficult that when I asked Sudhir to speak alone, he said, I'll come with another speaker. And then also they had a relay educational speaker turning turn by turn. They could not speak on one subject. We had a very good discussion, and the live people stream were 80. So we take a multiple of 3, so 250 people are watching it live also today. I would also request, I am happy that to know that this entire subject was selected by our Joint Secretary Abhay Mehta, and he coordinated with the entire with the speakers also. We are BCA is also still very fast, so I will now present photographs of the speakers clicked at this particular session itself. Thank you card. May I request Yogesh to propose a vote of
Good morning to everyone. Yeah, I'm telling the reason. If I break it in 2 words, it's good. Definitely the session was very good. And for morning, during my orientation, it was daily said that for chartered accountants, it's always good morning. I am greatly privileged and humbly honored to have been asked to extend the vote of thanks on the occasion of this lecture meeting. On behalf of BCS, I would like to take this opportunity to express my gratitude to Honorable Speaker C.A. Suresh Yadav and C.A. Sudhir Soni for providing insights on implementation of IndAS Accounting and Auditing Committee for organizing this lecture meeting, BCS President C.A. Narayan Pasari sir and Vice President C.A. Sunil Gawawala for their continuous support and the support team and of course all of you for participating and making it interactive. We have other lectures also like on 9th August, it's on business profession impacting lives shaping destinies at BCS Hall. The speaker is Shri Bharat Bhai Desai. On 17th August, filing of return under GST and associated IT challenges at BCS Hall. The speaker is CA Rajat Taleti. On 19th of August, it's definitely for students, not for you. Interactive session on success in CA exams at our own RVG hostel. I mean, my hostel actually. And the fourth one is expert chat at BCS on 1st September, concept and issues in place of effective management at BCS Hall. More details will be followed soon. Once again, a special word of praise and thanks to everyone.